Hi, and welcome to Early Retirement Roadmap, the show where I help you prepare for and thrive in early retirement. If you're thinking about retiring in your 40s, 50s, or early 60s, there's one expense that can make or break the whole plan. And it's not groceries, it's not property taxes, it's health insurance. For a lot of people, healthcare is the single biggest reason they don't retire early. Because you can budget for travel, you can cut spending, you can downsize. But it's hard to retire early if your health insurance suddenly becomes like a mortgage payment. And that's exactly what a lot of people are seeing right now. The Enhanced Affordable Care Act, or ACA subsidies, expired at the end of 2025, and many households are getting hit with premium shock. So today, I'm going to keep this practical and no nonsense. I'm going to do three things. First, I'm going to quickly explain why the ACA is still the most common path for early retirees, even with the higher premiums now. Second, I'm going to explain the one thing the ACA cares about, and it's not your net worth. And third, I'm going to give you a simple framework, 10 ways to pay less for ACA coverage by controlling the income number that determines if you get a subsidy and how much. And I'm focusing on the ACA because it's popular with early retirees for a simple reason. It's real insurance. ACA compliant plans can't deny you for pre-existing conditions, and they can't charge you more because of your health history. And marketplace plans cover the essential health benefits, the baseline set of things you actually expect health insurance to cover. So for many people, the ACA is the most realistic bridge to Medicare at 65. And yes, there are other options. COBRA can be a useful short-term bridge, but it's often more expensive than the ACA because you're typically paying the full premium. Now you're covering the costs that your employer used to pay, plus a small admin fee. So some people do part-time work specifically for benefits, and some people look at health-sharing ministries, but those are not the same thing as insurance, and there's no guarantee they'll pay like an insurance plan would. And you'll also see short-term or other non-ACA compliant plans advertised online that can look cheaper until you look closely at the coverage details and protections. So yes, options exist outside of the ACA. And last year, I made a comprehensive podcast comparing those options, the pros and cons of each. It's the 5th episode in this podcast, so on the platform you're listening on, you'll want to scroll down to find it. It's called Health Insurance Options for Early Retirement, What You Need to Know, and I'll also post this in the description or show notes of this episode. But for this episode, I want to stay focused on the ACA and the MAGI levers because for most early retirees, it's the most realistic bridge to Medicare for the reasons we just covered. All right, now here's the key concept you have to understand. The ACA is income-based, not asset-based. Let me say it again because this is the whole game. You can have a big portfolio. You can own your own home. So you can have a lot of assets and still qualify for ACA help because the ACA does not look at your net worth. It looks at your household modified adjusted gross income, or MAGI. And the savings we're talking about, premium tax credits or subsidies that most people know by, generally only apply if you enroll through the marketplace. That's why early retirees have an advantage. When you're working a W-2 job, your income is largely decided for you. When you're retired early, you often have more control. You can choose what account to pull from. You can choose when to realize capital gains. You can choose how much to convert to Roth and if you do it at all. You can choose to fund some of your retirement savings off of cash. And if you understand how those choices affect MAGI, you can sometimes save thousands a year on health insurance. Now, quick timing note. If you're watching this during open enrollment on healthcare.gov, the deadline is typically mid-January. And in many places, it's January 15th. Some state exchanges have different deadlines, so always check your state. But here's the bigger point, and this is something a lot of people don't realize. Even after you enroll, you can update your marketplace income during the year. You can report income changes as they happen and adjust the savings you get. That's literally built into the system. And if you don't do that, if your income estimate is wrong, you can end up owing money back at tax time. Now, before I give you the 10 levers, I want you to understand what changed in 2026. The ACA premium tax credit or subsidies still exists, but what's changed is the temporary enhanced subsidies have expired. That extra help that started in 2021 and ran through the end of 2025. And those enhancements mattered for two big reasons. First, they made subsidies more generous for a lot of middle-income households. Second, and this is the big one, they effectively eliminated the 400% of federal poverty level cliff based upon your household MAGI. Under the enhanced rules, once you got to higher incomes, your premium for the benchmark plan was essentially capped as a percentage of income, so the subsidy didn't suddenly drop to zero at a hard cutoff. Now that those enhanced subsidies have expired, we're back to the old structure again, where subsidies are tied to your household MAGI as a percentage of the federal poverty level or FPL, and the cliff at 400% of FPL becomes a real risk. Meaning, if your household MAGI creeps just over that line of 400% of FPL, you can lose a subsidy and see your premium jump dramatically. That's why MAGI control is even more important now. And one more quick nuance before we get into the levers. Yes, the big line everyone talks about is 400% of FPL for premium tax credits for subsidies. But if your MAGI is under 250% of FPL, look closely at silver plans because that's where you may qualify for cost-sharing reductions, which can dramatically lower deductibles, copays, and coinsurance. So it's not just about the monthly premium, it can be about the out-of-pocket costs too. And to make this easy, I'll include a link in the description to the federal poverty level table by household size so you can quickly see where your household lands, which brings us to the main event. Here are the 10 levers that early retirees can use to control MAGI and potentially lower ACA premiums, and I'm going to keep these very practical. Lever number 1, know what counts as MAGI and what doesn't. Now, this sounds basic, but it's where most people mess up. ACA uses MAGI, and while the full definition is tax codage, the practical takeaway is not all money you live on shows up as MAGI. For example, if you sell an investment in a taxable brokerage account to fund your expenses and early retirement, only the capital gain portion generally counts as income, not the entire amount you withdraw. That mental shift alone changes your retirement math. And to help with this lever, to help you know how to calculate MAGI, I've got a free MAGI Excel template you can download that I'll put a link to in the description or show notes. You can use this to estimate your MAGI and can update it to keep track of your MAGI throughout the year. And before you use it, you may want to listen to my podcast titled ACA MAGI, How to Calculate and Manage It for Big Savings, that explains exactly how MAGI is calculated. And I'll also put a mention of this episode in the description or show notes. Lever number 2 is use an HSA to lower your MAGI if you're eligible. If you're enrolled in an HSA-eligible high-deductible health plan, contributing to a health savings account can be a sneaky good MAGI lever. And here's what's new for 2026. If you're buying through healthcare.gov, all bronze and catastrophic marketplace plans are now HSA eligible. So this lever is available to a lot more people than it used to be. Why? Because HSA contributions can reduce your taxable income, which generally reduces your MAGI, while also building a dedicated bucket for deductibles and medical bills. And HSAs are what I call triple tax advantage. Tax deductible going in, tax-free growth, and tax-free withdrawals for qualified medical expenses. Also remember that HSAs are great for medical expenses, but generally can't be used to pay your ACA premiums. So think of it as an out-of-pocket cost tool, not a premium tool. Lever number 3, use cash as a MAGI buffer. If you have a cash runway, savings, a money market fund, CDs, etc., you can use some of that to cover spending without forcing taxable income in a year where you're trying to keep your household MAGI under 400% of FPL to keep health insurance subsidies. But let me add an important note here. This is something you do when you're close to the line, when, without pulling this lever, you might slip just over 400% of FPL and your premiums skyrocket. Because you need your cash runway in retirement to protect you from sequence of returns risk, meaning if the market takes a dive early in retirement, you're not forced to sell stocks at the worst possible time. So think of cash as a MAGI shock absorber, not a lifestyle plan. What's not smart is burning down your cash reserves year after year just to keep premiums low and then putting yourself in a position where you're exposed in the next market downturn. So the goal is balance. Use cash selectively to smooth out a high MAGI year while keeping your runway intact for when you really need it. Lever number 4 is use Roth strategically as a potential pressure relief valve. Normally, Roth is the last bucket you want to tap. It grows tax-free and qualified withdrawals are tax-free, so it's an incredibly valuable account to protect for later. But here's the early retirement twist. If pulling money from pre-tax accounts or realizing extra capital gains could push your household MAGI over 400% of FPL, using Roth selectively can keep you under the line and save you a lot in premiums. Quick clarity on what Roth money means. If you're under 59.5, you can typically access your Roth contributions, otherwise known as your basis, tax-free and penalty-free. A fully qualified Roth withdrawal, including earnings tax-free, generally requires you to be age 59.5, and there's the 5-year rule. And the 5-year rule is simple. The clock starts with your first Roth IRA contributions counted in tax years, and after 5 tax years, Roth earnings can be tax-free if you're also age 59.5 or meet an exception. Here's a practical use case. If you need an extra few $1,000s for spending and another taxable move would push you over the cliff, consider filling that gap from Roth instead. Just be careful with this lever as Roth rules get nuanced fast. There are ordering rules, and if you're under age 59.5, Roth conversions can have their own 5-year clocks for penalty purposes, and qualified versus not matters. Lever number 5, control capital gains on purpose. This is the lever most people underuse because when you sell in a taxable brokerage account to fund your living expenses in retirement, what usually flows into your ACA household MAGI isn't the whole amount you sold, it's the capital gain. So if you need $10K to fund spending, the question isn't just what do I sell, it's how much capital gain will this sale create? And the lower you keep your capital gains, the easier it is to keep your household MAGI under that 400% of the federal poverty line. In a taxable brokerage account, you can often control whether you realize no capital gains, some capital gains, or a lot of capital gains. And the difference between some and a lot can be the difference between affordable ACA and painful ACA. So the rule here is simple. Don't accidentally harvest capital gains. Harvest them intentionally. Here's the practical move. If you're selling investments to fund living expenses, consider selling shares with a higher cost basis first. Same spending money, but potentially less capital gains, which means lower MAGI, which means a better chance of staying below that 400% FPL cliff. And if you have multiple lots, sometimes called tax lots, this is why lot selection matters because you can choose the lot that creates the least gain for the amount of cash you need. Lever number 6, watch dividends and interest, the silent MAGI problem. Now this one surprises people. Dividends feel like free money, interest feels harmless, but both can push MAGI up quietly. If you have large dividend holdings storing up income or a lot of taxable interest from bonds or cash products, that income can raise MAGI even if you didn't do anything. So the tactic is, if you're trying to keep MAGI under control, don't ignore this. Run the numbers. Lever number 7, Roth conversions. Powerful, but they can wreck you. Roth conversions can be one of the best long-term tax planning tools for early retirees, but they are also one of the fastest ways to blow up ACA affordability if you do them blindly, because conversions add to your household MAGI. So the move isn't don't do conversions, the move is do conversions with guardrails and timing. Here are 2 practical ways to think about it. Option A, convert during your ACA years, but cap it. Pick a target MAGI range to keep subsidies and convert up to the line, not past it. Option B, if you need big conversions, consider waiting until Medicare. Once you're on Medicare, you're no longer playing the ACA subsidy game, so you may have more freedom to convert without triggering that 400% FPL cliff. And there's a window after Medicare starts at 65 and before required minimum distributions or RMDs kick in, often 8 to 10 years, depending on your required distribution age. But keep in mind, Medicare has its own version of income consequences, and it's called Income-Related Monthly Adjustment Amount, or IRMA. IRMA can raise your Medicare Part B and Part D premiums if your income is high enough, and it uses a 2-year look-back. So the trade-off usually is this. During ACA years, the extra conversion dollars can cost you a lot in premiums. During Medicare years, extra conversion dollars might increase taxes and may trigger IRMA, which is often a smaller hit than losing ACA subsidies, but it's still real money. So if you're doing conversions, the right mindset is convert intentionally in the right years with a clear target, not just convert as much as possible. Lever number 8 is use the right withdrawal mix. Here's a simple framework many retirees use, especially before Medicare. Spend from cash or cash equivalents when needed, like we talked about, selectively to stay under your MAGI target. Use taxable brokerage in a capital gains aware way. Number 3, use Roth strategically, like we covered. And lever number 4, use pre-tax accounts strategically, but understand every dollar adds to MAGI. That's not the one perfect order for everyone, but it's a useful starting point because it aligns with the main goal. Keep flexibility, keep MAGI under control. Lever number 9 is update your marketplace application during the year. This is the lever most people don't know exists. If your income changes or you realize your estimate was off, you can log in and update it. So if you're listening to this and you're thinking, I already enrolled, it's too late. Nope, you can still manage this. The marketplace was built for real life where income changes. Lever number 10, bonus levers. And I want to give you some bonus levers, some quick hitters. If you're right on the edge of a subsidy line, these can also help depending on your situation. Tax loss harvesting. Realizing losses can offset realized capital gains, which can lower MAGI. There's also a charitable strategy. Donating appreciated shares instead of cash can avoid realized capital gains. And third, pre-tax retirement contributions. If you have earned income, those deductible contributions can lower MAGI. Now, you don't need all of these levers, of course. They are just options to help you reduce your MAGI and reduce your ACA health insurance costs. You just need the right levers for you to pull, and that's how early retirees keep health insurance from becoming the thing that derails their whole plan. And this is how people are pulling this off and retiring early and controlling their health insurance costs. They are doing it by understanding the rules and using the levers. And take a moment to download my free early retirement checklist. It's called the 12 Must-Do Steps to Retire Sooner and Smarter. It offers a quick, practical guide to retiring early. You'll find a link to it in the description or show notes, depending on the platform you're listening on. And share this podcast if it helped you. And when you're not on the go, check out my Early Retirement Roadmap YouTube channel and go to mikeupland.com for all of my media and resources in one place. Thanks for listening, and until next time, take care and make the most of today.